Okay, so you want to own a Cybertruck. Stainless steel, bulletproof glass that isn't actually bulletproof, a shape that looks like it drove out of a video game. But here's the contradiction nobody puts in the brochure. This is the only vehicle in America where the tax code treats it like a bulldozer and the sidewalk treats it like a declaration of war. By the end of this, you'll know exactly what the first invoice hides, why the government will happily pay for a third of it, and why some owners are now paying to make it disappear. Let's start with what Tesla will actually sell you. The entry point in 2026 is the dual-motor AWD at just under $70,000. And that number only exists because Tesla tried launching it at $59,000 and quietly walked it back up within 10 days. Step up to the premium AWD and you're at $80,000. Go all the way to the Cyberbeast and you're at $99,990, a price that itself got slashed from an original $114,000 because nobody was buying it at the old number. And if you wanted in during the very first year, when Tesla was still calling it the Foundation Series, the sticker was closer to $120,000, before flippers on auction sites pushed resale prices past $150,000. That same $150,000, parked in an index fund instead of a driveway, would already be quietly compounding toward your retirement instead of your insurance bill. For the money, you get 400 miles of range, faster charging than almost anything else on the road, and a truck bed that can power your house during a blackout. Meanwhile, a Ford F-150 with more towing capacity and a fraction of the drama costs half as much. And here's the thing. The purchase price isn't even the real number. It's the entry fee to a much longer bill. Because the Cybertruck is just the start. This is a truck with 11 federal recalls in under 3 years, more than any other pickup currently sold in America. One recall alone, over the sail-mounted trim piece detaching at speed, touched 4,000 to 6,000 vehicles. Insurance runs around $24,000 over 5 years, and that's before anything actually happens to the truck. And something usually does. Here's a question worth sitting with. What happens when a vehicle made of cold-rolled stainless steel gets into a fender bender that would cost a normal truck $400 to fix? A cracked front panel alone runs $1,900. A bent fascia is another $900. Add labor, recalibration of the cameras, and the fact that only Tesla-certified technicians are allowed near the body, and a light tap in a parking lot can clear $6,000 before anyone's even hurt. Kelley Blue Book now estimates the full 5-year cost of ownership at $84,500, and $41,000 of that is depreciation alone. Add it up, and the truck that cost $70,000 to drive off the lot is quietly billing you nearly $17,000 a year just to exist in your garage. And there's a cost most buyers never budget for at all, because it isn't a person, it's a network. Every stainless panel that gets bent has to go through a body shop willing to fight Tesla's own repair standards, an insurer that doesn't want to pay for them, and a certified technician pipeline that's still being built out state by state. One consultant who specializes in fighting these claims for owners has watched a single Model 3 repair balloon to $22,000, $14,000 of it in parts alone. That's not staff on a payroll. That's an entire specialized labor economy you're renting by the incident, and you don't find out the hourly rate until you've already crashed. Now we get to the question that actually matters. Where does the money come from, if this thing barely earns anything on its own? The answer isn't in the truck. It's in the paperwork. Any vehicle with a gross weight rating over 6,000 pounds and a cargo bed that isn't easily accessible from the cabin qualifies for something the IRS technically calls Section 179, and the internet calls the Hummer loophole. Buy a Ferrari for your business and the luxury auto depreciation caps limit you to writing off maybe $60,000 over 6 years. Buy a Cybertruck for your business, and because it clears that weight threshold, you can write off the entire purchase price in year 1. On a $99,000 Cyberbeast, a business owner in the 35% bracket effectively gets the government to hand back around $35,000 the same tax season. That's not a tax benefit in the vague sense people throw around. That's a specific mechanism, built for combined harvesters and delivery vans, that a stainless steel status symbol happens to slide straight through. Wealth preservation here isn't a trust or an offshore account. It's a truck bed length. And that's only the first layer. Watch how this compounds if you actually run it as a business asset. You buy the truck, wrap it in your company logo, and suddenly you're driving a rolling billboard to every job site you visit. That visibility brings in leads. Those leads become signed contracts. Those contracts generate cash flow, and that cash flow, combined with the year-one tax write-off, frees up capital you'd otherwise have parked in a depreciating diesel fleet. Reinvest that freed-up capital into more equipment, and your business scales faster than a competitor who financed a normal truck the boring way. That's the chain on paper. Rolling billboard, leads, contracts, freed-up capital, faster growth. The object is rarely the investment. The mechanism underneath it is. If you're the kind of person who wants to see how these tax mechanics actually get used and abused once the truck leaves the dealership, you'll want to be around for what happens next in this series. Because here's what nobody tells you about buying a Cybertruck. You're not buying a truck. You're buying a stack. Layer 1 is the tax mechanism you just heard about. Layer 2 is the marketing asset. A truck so unmistakable that people photograph it in parking lots for free. Layer 3 is a genuine off-grid power source, a truck bed that can run your tools or your refrigerator during an outage through Tesla's PowerShare system. Layer 4 is scarcity, or at least it was, when getting one meant a 2-year waitlist. Layer 5, and this is the one nobody guesses, is identity. Buying a Cybertruck was never really about hauling lumber. For most owners, the layer they actually paid for was the statement it made about who they were. That's the layer that was about to turn on them. Because underneath the marketing, there's a system built to maximize exactly 4 things: manufacturing simplicity, brand attention, software revenue, and Elon Musk's own visibility. The unpainted stainless body wasn't chosen because it's cheaper to fix. It's actually harder to fix. It was chosen because it removes an entire paint shop from the factory and turns the truck itself into a walking advertisement nobody has to pay media dollars for. The psychology runs the same way. Full self-driving isn't sold to you once anymore. As of February 2026, Tesla killed one-time FSD purchases entirely. So what used to be a feature is now a $99 monthly subscription you keep paying whether you use it or not, and it can't even transfer to your next Tesla. And underneath all of it sits the data layer, every mile, every charge, every software update feeding back into a company whose stock price still moves on one man's public behavior more than any spec sheet. Every panel, every subscription toggle, every recall notice traces back to one of those 4 numbers. Myth: rich people buy Cybertrucks because the depreciation doesn't matter to someone with that much money. Reality: a meaningful share of wealthy buyers are avoiding this exact truck for the opposite reason. Because owning one has become a public statement they can't control once it leaves their driveway. Take the driver who goes by LiftDR1ver on the Cybertruck Owners Forum. A rideshare driver working 7-hour shifts out of Nashville. He put over 100,000 miles on his truck ferrying passengers. And for most of that run, the economics were beautiful. Charging cost him around $12 a day, roughly $350 a month, a fraction of what a gas truck burns doing the same mileage. He was the success story the tax mechanism was built for, a workhorse quietly printing savings every single week. Then the warranty ran out, and the truck sent him a $7,200 repair bill in a single notification. He says he still wants to push it to 1 million miles. That's either loyalty or denial, and honestly, it might be both. Now meet Yoni Menaka, who owns Blue Angel Roofing in Atlanta. He bought a Cybertruck as his company vehicle, wrapped it with his business logo, and treated it exactly like the marketing asset the flywheel promises. For a while, it worked. Then, sometime in 2025, the truck itself became the reason people stopped calling him back. "I've started to lose customers because I drive a Cybertruck," he wrote in an owners group, and he wasn't exaggerating. He says the decision cost him $70,000 in contracts. One online review of his company put it bluntly: if a roofing company shows up in a Cybertruck, maybe find another roofer. And here's the part that makes it sting. Menaka still loves the truck. He calls it the best truck he's ever owned. He just can't afford to be seen in it anymore. Would you have kept driving it anyway? Or pulled the wrap and quietly parked it around back? That's the actual dilemma this whole story runs on. But the Cybertruck does have one real, structural problem. And it isn't the recalls or the repair costs. It's that the asset's value is tied to a single man's public behavior in a way almost no other vehicle in history has been. When Elon Musk aligned himself publicly with the Trump administration in early 2025, Cybertrucks became targets, not just of jokes, but of actual vandalism, keyed panels, and swastika stickers left on trucks whose only offense was existing. Tesla dealerships were left sitting on more than $200 million of unsold Cybertruck inventory they couldn't move, and some dealers stopped accepting Cybertrucks as trade-ins entirely, because they didn't trust their own ability to resell them. Sales fell 48% in 2025 alone, faster than any other electric vehicle on the market. This is still happening today, every time Musk's name trends for a reason that has nothing to do with trucks. Which is exactly why a meaningful share of wealthy buyers deliberately avoid this one. If your actual goal is status, privacy, or simply not becoming a moving political headline, ownership stops making sense, and leasing or simply choosing a different heavy pickup for the same Section 179 benefit starts looking a lot smarter. Because the tax mechanism works on a Ford Super Duty or a GMC Hummer EV2, without the brand risk riding shotgun. And if your business depends on looking neutral and approachable to a broad customer base, the way Meneka's roofing company does, this is simply not your work truck, no matter what the accountant says about the deduction. So let's do the actual math. Picture a small business owner who buys a Cyberbeast for $99,990 and puts it straight into service, logo, and all. In year one, the Section 179 write-off hands back roughly $35,000 at a 35% tax rate. Insurance runs another $4,850. Even with zero accidents, that leaves an effective first-year cost of around $6,000 to $9,000 for a truck the government essentially subsidized by a third. On paper, that's a fantastic trade. Now the realistic version. Add one parking lot fender bender, roughly $6,000 in stainless panel repairs. Add the resale reality, where dealers were reporting values down 34 to 50% inside 12 months, wiping out another $35,000 in paper equity. And if the brand backlash costs you client contracts the way it cost Meneka, tack on another $70,000 in lost revenue that never even shows up as a line item, it just quietly doesn't happen. Stack it together and that same truck, the one that looked like a $35,000 government discount, is now sitting somewhere north of $140,000 in real economic damage. And yes, that first scenario was still the optimistic one. So how do owners actually get out? Some sell back to Tesla directly and eat the trade-in hit. Some list on the private market and hope a buyer values the novelty more than the resale data does. A handful fold the loss into a business write-down and move on, because the tax code that gave them the deduction also lets them absorb the depreciation. There's no elegant exit here, no auction house, no foundation donation. Just a straightforward sale at whatever the market will bear that week. Because what the wealthy buyer was really purchasing was never the truck itself. It was the stack, and specifically the identity layer sitting on top of it. The ability to be seen as an early adopter of the future. Nobody accounted for the possibility that the future they were signaling might become the thing people started keying in parking lots. The tax break was real. The horsepower was real. The identity they thought they were buying turned out to be the least stable asset in the entire stack. If you're the kind of person who wants to track what happens to this brand next, because a story that moves this fast doesn't sit still for long, this is a series worth sticking around for. Here's the paradox in one sentence. A truck engineered to be nearly indestructible turned out to have the single most fragile ownership economics of any vehicle sold in America. If you time the tax write-off and unload it before the brand catches up to you, this can genuinely work in your favor. If you hold it through the next controversy, you inherit a bill nobody put in the brochure. Somewhere above all of it sits the man whose name is now worth roughly $700 billion, more than the market value of most entire industries. The Cybertruck promised to be bulletproof. It survived every crash test Tesla ran on it. It never stood a chance against its own reputation.